If there's something going on in your retirement planning or your investment or your tax planning, and it's something you've never heard of before, and it could be costing you money, when would you want to know about it? Well, this year is coming to a close, and this may be one of the last years of low tax brackets. After all, if Congress does nothing, taxes are already set to increase in just 2 years. For this reason, a lot of what you think you know about year-end tax planning has changed. I'm Chris Abts of Cornerstone Wealth Management, and you are watching Redefining Retirement. This is where you can count on straightforward and objective advice on the toughest challenges you'll face in retirement today. And coming up on today's show, we're going to look at what you should be doing now to take advantage of our current tax laws and acts and how it could impact you. I'm going to share some concepts and strategies with you that could help you to pay less in tax this year, as well as long-term into the future. You see, in my experience, you're probably paying more tax than you legally have to, and you probably don't even know it. So if you want to pay less, then you definitely want to be paying attention to today's show. I know you're going to enjoy this. Here's what's coming up. And my hope is that by sharing these with you, that you might learn some strategies that you may want to use to keep more of your hard-earned money inside your pocket. So here's the deal. If your deductions are, say, just under those thresholds, you may benefit from postponing some of your deductions from 1 year or accelerating them into the next year. I'm really excited about today's topic, so sit back and relax. Redefining Retirement starts right here, right now. Saving and accumulating assets for your retirement is a great start, but it's what you do with your money that really matters. So how will you generate your income? How will you reduce your taxes? How will you reduce your risk? How will you pay for the skyrocketing costs of healthcare? And how will you optimize your Social Security benefits? Welcome to Redefining Retirement. I'm Chris Abts from Cornerstone Wealth Management, and this is where you can count on straightforward and objective advice on the toughest challenges you'll face in retirement today. On today's show, we're looking at tax moves to make before year end. So here's the deal. Most of what you know about year-end tax planning has changed. Today's tax rates, they are literally at 40-year lows, and there are now only 2 years left before they expire. But I don't believe it ends there, because with almost $34 trillion of U.S. national debt and rapidly growing, tax rates will have to increase for everyone, and that will likely have a big negative impact on your tax situation in retirement. And if you just continue to do what you've done in the past, then you're most likely going to pay a lot more in tax than you think. But I know you want better than that. You want better. You deserve better. That's why you watch this show. As a wise person once said, there are 2 tax codes in this country, one for the informed and one for the uninformed. Meaning, are you aware of the right tax saving strategies for your situation, and are you taking advantage of them? So on today's show, we're going to look at some simple concepts and strategies that could help you to pay less in tax this year, as well as long-term into the future. And if you're planning to retire in, say, the next 5 years, these tax increases, they could hit you just as you're retiring. And here at Cornerstone Wealth Management, our main focus is retirement planning. And when we meet with people, we help them to look at their specific situation, and we walk them through what they are facing. And one of the great benefits of this is that it helps them to see and understand in their specific situation how these tax increases will impact them. For example, your IRA and your 401k, you have been told that those are great places to put your money when you're working. And it's so easy to do that as well. So when you're working, every couple of weeks, the money automatically comes out of your paycheck and goes into your account. You even get a tax deduction when the money goes into that account. And you may have been doing this for 20, 30, 40 years, and many people don't realize that they haven't paid tax on this money. And these higher taxes, they could end up being a huge chunk. They could take a huge chunk out of what you're expecting in retirement, which could result in your hard-earned money being a small fraction of what you hoped you would have all through your retirement years. Now, many tax experts and economists, they believe that we could see massive tax increases to pay for the trillions of dollars in government debt, which is growing by about $2 trillion a year. Think about that. And that's why we want to help. Here at Cornerstone Wealth Management, we're passionate about helping families avoid these traps. So we're going to show you how you can reduce, or even in some cases, how you can eliminate your taxes in retirement with our free Cornerstone Retirement Tax Savings Analysis. So here's how this works. When you come in, we'll get some basic information from you, and then we'll determine the specific strategies that work best for your situation. And then we'll sit down and we'll share these strategies with you so you can see exactly how much money you can save in retirement. We're not talking about saving a few dollars on a few simple deductions. These tax strategies, they could literally save you tens of thousands, if not hundreds of thousands of dollars during your retirement. Now here's the best part. It's free. There's no obligation. But you do have a short window of opportunity to take advantage of these tax planning strategies. So don't wait, give us a call. And when we come back, I'll share with you some of the tax strategies that our team here at Cornerstone that we use to help our clients to pay less tax, not only this year, but long term into the future as well. We'll be right back. Could your tax bill in retirement be larger than you think? Taxes can play a significant role in retirement. After all, they determine how much of your hard-earned savings you get to keep and how much you send to the IRS. If you're like many savers, you may not know the total amount of taxes you could potentially pay. I believe information is critical to making informed decisions about retirement. If you agree, I want to share a resource that can help. Use your phone camera to scan this QR code. It will take you to a page that generates a quick report that can help evaluate your potential tax bill in retirement.
Approaching retirement requires a shift in how you view your investment and income portfolio. Are you making the transition successfully? Author Chris Abts, in his latest book, Maximizing Your Income, will show you how to structure your income while avoiding 10 retirement pitfalls. You'll also learn 3 strategies to create sustainable retirement income. Learn to plan for potential healthcare costs and how to avoid 4 common yet costly Social Security mistakes. The information you gain from this book may help you retire sooner and help you stay retired. Get your complimentary copy today at MaximizingYourIncome.com and take control of your retirement.
Stay informed on the latest news and events affecting retirees at cornerstoneway.com.
Welcome back to Redefining Retirement. I'm Chris Abts from Cornerstone Wealth Management, and this is where you can count on straightforward and objective advice on how you can make the most out of every dollar you've saved for retirement. Now today, we're looking at tax moves to make before year end to help you to pay less in tax this year as well as long term into the future. These are some of the strategies that our team here at Cornerstone that we use with our clients to help them pay less in tax as well as increase the value of their savings and investments. Now, as you know, the less you pay in tax, the more you have to save for your future and or use to spend on yourself and your family. And my hope is that by sharing these with you, that you might learn some strategies that you may want to use to keep more of your hard-earned money inside your pocket. But remember, to take advantage of these changes for your year-end tax planning, you need to act now before the end of the year. Also, here's an important note. Before you move forward and implement any of these tax ideas, just make sure that you're speaking with a professional. Very important. So here we go. Number 1, donate stocks as charitable gifts. Now, due to the growth in the markets recently, you may have some stocks with some significant gains. If that's the case, this may be a great year to donate some of those stocks as a charitable gift to your favorite nonprofit organization and also get a tax deduction at the same time. So many times, this is far better than just gifting cash due to the tax savings of not having to sell the stock. So when you make end-of-year gifts to charity, consider gifting stock instead of cash. But I want you to keep in mind that the standard deduction, that it's increased to $13,850 for a single person and $27,700 for a married couple. And deductions for property taxes, those are still limited to $10,000. Now, because of this, if you file your taxes as married or filing joint, you may need to donate a larger amount to charity to get a tax deduction for that gift. So for this reason, making a larger gift to something called a donor advised fund, well, that may give you a much larger tax write-off this year, and then you could disperse that money to charity over, say, the next few years. I'll cover this in more detail later in today's show. Now, the next strategy to consider, that's called tax loss harvesting. So this particular strategy, it means to sell some of your investments for a loss to offset any gains that you may have realized earlier in the year. And by realizing these losses, you may be able to offset the taxable gains that you may have created earlier this year if you did any buying or selling in your investment portfolio. Now, if you do follow this strategy, keep in mind that you will probably need to rebalance your portfolio to maintain your proper asset allocation. But just remember, if you buy back the stock within 30 days, you can't write off the loss. And here's where most people, they're trying to take advantage of this strategy where they totally miss it. So if you invest in, say, mutual funds, keep in mind that you've got an investment manager that's buying and selling inside those mutual funds. So if you do invest in a mutual fund and you apply this tax loss harvesting strategy, and then you end up getting a 1099 around the end of January, you can end up paying tax on the gains for those sales. Here's the kicker, even if you lost money in those funds that year. So that's just another reason why I don't like investing in mutual funds. All right, let's move on to the next one, which is to review your wills and your trust. So the current estate tax exemption today, it's almost $13 million. And that means, as a married couple, if you have less than $26 million, which includes most folks, and you pass away, there are no estate taxes to pay. Now the catch is that this inflated exemption level, it's going to drop down to an estimated $6.4 million in 2 years. Therefore, if you're looking to minimize your taxable estate, now is the time to create a plan and a strategy before this window of opportunity closes. All right. Also, if you have a will and it requires that a trust be funded after you pass away, you might want to update that, as you just might not need that trust anymore. Now, just keep in mind, though, there's still many non-tax benefits to having a trust. That could be things like avoiding probate, asset protection, and the list goes on. So in this situation, the right strategy can help to simplify your estate plan, reduce your estate taxes, and possibly even lower any income taxes for your family after you pass away. So here's an example. I recently met with a couple who didn't want to give a single dime to the IRS when they passed away. That's pretty common. So this would be an effective strategy to take advantage of to ensure that they would totally disinherit the IRS when they passed away. So I think that's a pretty cool opportunity. All right, the next strategy to consider is to make cash gifts to family members. So if you tend to give cash to some of your family members, well, the most recent Tax Act, it made some changes that you might want to be aware of. The annual gift tax exclusion amount, that's what we're talking about here. It refers to the amount of money that you can gift to someone each year, and that amount is $17,000 per person for this year. So that means if you do this properly, you can gift up to $17,000 to a family member this year without incurring a tax liability for you or for the person receiving this gift. If you're married, well, you can double that number to $34,000. So, two of the more common ways these gifts are typically made is with cash or by gifting things like stocks. Also, if you have something like a family limited partnership or perhaps a legacy trust or maybe a wealth replacement trust, you'll know it if you have those, you can use your annual gift tax exclusion to transfer assets or ownership using these types of estate tools. Now, this could also be implemented for estate planning opportunities to transfer wealth, eliminate tax, and also create some asset protection as well. So that's pretty cool. And I don't want you to think that these types of strategies are only for the rich, because that's simply not true. All right, let's move on. The next strategy you may want to consider is to make the maximum 401k contribution. Now this year, the maximum amount that you can contribute to a 401k is $22,500. Now, if you didn't take advantage of this strategy this year, or maybe you did, you now have the opportunity to start next year with at least one tax-smart strategy. So the maximum amount that you can contribute to a 401k this year, again, $22,500. So if you can, make sure that you're on schedule to contribute that maximum amount. Plus, if you're at least age 50, you can do what's known as a catch-up contribution of an additional $7,500, meaning you might be eligible to put as much as $30,000 into your 401k this year. And for 2024, the maximum amount you can put in your 401k, as well as the catch-up contribution, it increases to $30,500. Now, one way to increase your 401k contribution is to increase your payroll deduction through your HR department or your company's online system. Plus, if you own a small business, there are several strategies that you should be aware of where you could put away a whole lot more. Here's an example. If you have a small business, the recent Tax Act, it allows you to set aside up to over $250,000, $265,000 in a year to be exact. And again, that depends on your particular situation. So a lot of leeway there. So in other words, if you own a small business, you may be able to avoid the tax on a pretty sizable portion of your income. So if you think this may be a benefit to you, give us a call to learn more about this concept. All right. The next concept is to fund your individual retirement account, so your IRA. Now, the max you can contribute this year, it's $6,500. And again, if you're age 50 or older, you can contribute a max of $7,500. Keep in mind that the deadline to make your 2023 IRA contribution, it doesn't end on December 31. So you have until April 15th of next year to get this money into that account and still have a count towards your 2023 contribution. Now, another one to consider is to top off your health savings account. So if you have a high deductible medical plan through work, you may be eligible for that HSA. So it's another great way to save even more on taxes. Now, for this year, the maximum contribution for an individual is $38.50, and for families, it's $77.50. Now, the annual catch-up contribution amount, if you're age 55 or older, that's an additional $1,000. Now, if I asked you how much money you have saved for retirement, you probably know that right off the top of your head. But if I asked you, how much money do you owe in tax on your IRAs and your 401ks? Most people don't have a clue. I believe that is one of the most important numbers that you need to know. Because if you don't know how much that you will owe in tax on your IRAs and 401ks, then you really don't know how much money you have saved for your retirement. So that's why we put something together for you today. I want you to discover how you can reduce your taxes in retirement with a free Cornerstone retirement tax analysis. So here's how this works. First, we'll get some basic information from you. Then we'll determine the tax saving strategies that are best suited for your specific situation. And then we'll sit down and we'll share these strategies with you so that you can see exactly how much money you could save. And as we've just learned, your tax savings could be significant. It could be tens of thousands, if not hundreds of thousands of dollars in retirement. Now, many advisors will charge thousands of dollars for a customized analysis like this, but we won't charge you a dime. So if you've saved at least $250,000 for your retirement, give us a call to schedule your free customized analysis. And when we come back, we're going to take a look at 2 more critical retirement planning mistakes that could wipe out your hard-earned savings. We'll be right back.
At Cornerstone, we believe you should be able to enjoy the retirement you have always wanted. To help you see your retirement strategy from all angles, we created a retirement roadmap, which is designed to help you discover the knowledge you need to take control of your money and live a confident retirement regardless of what challenges arise. So you envision the life you want to live, and we can help you create a plan that leads you down that path. Join us for a conversation about your vision for your ideal retirement by calling the trusted professionals at Cornerstone.
When you have confidence in your retirement future, you can live the life you've always imagined. Because of planning, you now have time to reflect on the wonderful memories of your life. Spend fun times with your grandkids, sharing the joy of their excitement about life. At last, you have time to breathe and rekindle the love of your life. Why? Because you imagined what could be. You planned for retirement. So today, you own your future.
For trustworthy fiduciary-based guidance, Call 775-853-9033.
If you'd like more information about financial planning, industry news, and market updates, you can subscribe to our blog. Visit our website at cornerstoneway.com. The resource request box is located on the bottom right-hand corner of the homepage. There you can submit your information to subscribe to our blog.
Welcome back to Redefining Retirement. I'm Chris Abts from Cornerstone Wealth Management, and this is where you can count on straightforward and objective advice on how you can make the most out of every dollar you've saved for retirement. Now today, we're looking at some tax moves to make before year end to help you to pay less in tax this year, as well as long-term into the future. Now before the break, I shared several ideas and concepts with you in the hopes that you can use some of these to pay less in tax this year. So call this your year-end tax planning checklist. And as a quick recap, the first one we looked at was donating stocks as charitable gifts. Next was tax loss harvesting. The third one we looked at was to review your wills, trusts, powers of attorney. The next was make cash gifts to family members. Fifth was to make the maximum contribution to your 401ks. Next was to fund your IRA. And the last one was to top off your health savings accounts. Now, here are four more year-end tax planning strategies that you might want to consider to reduce your tax liability this year, as well as to set yourself up to pay less tax in retirement as well. So here we go. Next one, bunch itemized deductions. This is a big one. Under the current Tax Act, big changes were made to the way that you itemize deductions in these prior years. Now, as you may be aware, several deductions, they were eliminated, but the standard deduction increased. So that means that depending on your situation, you may not be able to itemize deductions this year. So here's what I mean. If your itemized deductions, if they do not exceed $13,850 if you're single, or $27,750 if you file as married, then none of your deductible expenses will reduce your taxable income. So here's the deal. If your deductions are, say, just under those thresholds, you may benefit from postponing some of your deductions from 1 year or accelerating them into the next year. So one example would be to make one additional property tax payment 1 year, make one fewer payment in the following year. Another example, that could be to make your January mortgage payment in December. You could consider doubling up on your charitable contributions every other year while deferring contributions the following year. So a lot of different ways to do this. So here's an example. If you give $10,000, say, to your church every year, you may want to consider giving $20,000 1 year, then nothing the next year. Now, if you don't like the idea of contributing to charity 1 year, and then contributing nothing to charity the next year, you may want to consider a donor advice fund. And we talked about this earlier. So this is our next strategy, a donor advice fund. So a donor advice fund, it's like a charitable IRA. You get the deduction the year you put the money into the fund. The money then stays in that fund and will earn tax-free income until you decide to distribute the money to the charity or charities of your choosing. Now, by doing it this way, you may realize a larger charitable deduction up front, and then you can gift the money to the charity or charities of your choice as you see fit when you want to do it. Now, if you really want to turbocharge your tax savings, then consider gifting some highly appreciated stock or mutual fund shares. Now, doing it this way, you will get a deduction for the full value of the gift, here's the cool part, without paying tax on the appreciation. So in meetings with individuals and couples looking to take advantage of their tax savings opportunities, our advisors could help to identify the investments with the greatest appreciation and then help set up a plan to use those funds for gifts. So bottom line, if you want to turbocharge your charitable deductions, a donor advised fund, it just might be the way to go. All right, the next concept is Roth conversions. We've talked about this before. If you're in a low tax bracket, you may want to consider converting a portion of your IRA to a Roth at little or possibly no extra tax cost. Now, while you have to pay tax on the money you take out of your IRA, once you transfer it into a Roth account, it grows tax-free for the rest of your life, and you're never required to take a required minimum distribution when you reach age 73. Plus, if you set it up correctly, it can continue to grow tax-free for your spouse, your children, and your grandchildren as well. Now, here's another idea that you might like. Qualified charitable distributions, QCDs. So this strategy, it might make sense if you don't itemize on your tax return. So say you're age 73 or older and you have to take a required minimum distribution from your IRA, and you also give money to charity. Then you may want to have that charitable gift go directly from your IRA to that charity. So if you do it this way, you won't get the tax deduction, but you won't have to report that gift as taxable income. That's a big deal. So there you go. 4 more strategies to help you to be tax smart this year. Now, would this be one of those critical pieces of information that you would want to know before making important financial decisions? Imagine making a decision about your tax planning without this type of information. And can you see how not being aware of this type of information could potentially cost you a significant amount of money now and long-term into the future? So what's the point of today's topic? Sure, you want to pay less in tax, I get that. But the larger point is, do you know what questions to ask in order to have all the critical information that you should know to ensure that you're making the right decisions that are in your best interests? See, if you don't have a process or a structure or a set of questions to ask, then many times important pieces of information, they're being left out of your financial decisions. And over the past few years, there have been several things that we have been unable to control. But this area, taking back control of the taxes you will pay now and during your retirement, this is an area where you can really take back control, which can give you more confidence in your retirement. So here's the bottom line. Taxes will likely be your biggest expense in retirement. And you may be massively underestimating the taxes you'll end up paying over this phase of your life, especially due to the fact that taxes are scheduled to increase just 2 years from now. But right now, today, there are strategies that you might be able to take advantage of to dramatically reduce those taxes with a free Cornerstone Retirement Tax Savings Analysis. Here's how this works. First, we'll get some basic information from you. We'll determine the tax saving strategies best suited for your specific situation. Then we'll sit down and we'll share these strategies with you so you can see exactly how much money you could save in retirement. These strategies, they could save you tens of thousands, if not hundreds of thousands of dollars. So, if you saved at least $250,000 for your retirement, give us a call to schedule your free analysis. That's our show, and I hope you enjoyed it. I look forward to seeing you next week.
Jolly good show.